Sean. It's a high margin type operation, and that's really important to keep in mind. When we look at the overall margins and the after-tax free cash flow that will be generated over the 11 years of actual mining within the mine plan, we're averaging between 80 and 100 million dollars Canadian of free tax cash flow each year. I think we peak at just over 120 million dollars in year seven. And again, this is using $2,400 gold. So we don't need a gold price of over $3,000 to make this look attractive as a high margin potential development. It really works on its own merit and is really, we think, pretty self-explanatory and when looking at the opportunity. And it's something that we want to try and show compared to some of our higher profile comparables. When we look at comparable developers or sort of pre-development type stories that have PEA or PFSs that have been published since 2024, largely trying to look at underground operations. If we look at a metric like what the annual after-tax cash flow per ounce produced is, Shovelnose compares very well, almost $1,300 Canadian an ounce on this basis, and we think that reflects again the low cost nature of this development, but also it helps highlight that at 56,000 ounces a year, that's pretty good. We don't need to necessarily hit that 100,000 ounce a year sort of threshold or target that we often hear about for Canadian development stories. That target, we believe, is sort of used when evaluating development opportunities, largely because there is a bigger capex that's required in order to get it into production. There's sort of a big infrastructure project that's required in order to get that deposit into production as well. We don't have that, so at 50,000 plus ounces per year, this is a really attractive development story, and it's something that we need to continue to advance on.